Welcome to another episode of the Student Loan Planner Podcast. I wanted to let you know, every 6 months, we completely overhaul and update our flagship investing course, Six-Figure Debt to Six-Figure Net Worth. We're offering a $100 discount for the next 2 days. And to get that, you could go to studentloanplanner.com/investing. And you can also find the link on the homepage of our site. If you go to studentloanplanner.com, you'll see in the menu a button for course. In the menu, you just click that course link and it'll take you to the right discount page. So $100 off for the next 2 days. This is our most popular product we have besides our consulting service. So we're going to talk about in 2021, how do you become wealthy given all the scary things going on in the world and given how 2021 is probably going to look so different from 2020. Pretend that it's December 31st, 2019, and the Dow Jones, which is like kind of one of the things that people talk about when they're talking about the level of the stock market, it was at 28,500. And someone from the future comes and tells you what's going to happen in 2020. Maybe you would have, I don't know, run away to a secluded island or jumped off a bridge or just taken cover under your desk. I don't know. It would have been pretty interesting to find out what was going to happen in 2020. I'm kind of glad we don't know the future, honestly, because it would have been pretty depressing to find out everything that was going to happen. But let's say that this person from the future, instead of just, mindlessly scaring you, they decide to tell you what will happen, but they're not going to tell you what happened in the stock market. They're just going to tell you a list of events, and they tell you the following. In 2020, and again, we're pretending it's December 31st, 2019, right? So in 2020, they're going to tell you that we're going to see the president impeached. We're going to have a virus called COVID-19 that's going to kill hundreds of thousands of Americans, and it's going to be the worst pandemic since 1918. We're going to see a black man murdered on live television that will spark the largest protest for racial justice that we've ever seen. There will be unrest and rioting in big cities. We'll see a record homicide rate that's the worst in many decades in many parts of the country. And just as a bonus tip, we're going to have an insurrection with rioters storming the Capitol that supported President Trump that are seeking to overturn the results of a free election to undermine democracy. So if you had heard all of those things for this person telling you this in 2020, what would you have guessed what was going to happen to stock market levels at the end of the year? So remember, the Dow was at 28,500 at the end of 2019. So what would you have guessed the Dow Jones would be at the end of that kind of a 2020? Oh, and also, I guess I left off the part where 2020 saw record levels of unemployment that we haven't seen since the Great Depression. Maybe you would say, well, let's say Dow 20,000, or maybe Dow 15,000, or maybe even lower than that, just because of how shockingly terrible the description of 2020 would have been. And I know I threw in an event that happened technically in 2021, but just to save the honor of 2021, I'm lumping this first week of January in with the prior year. So let me just say that. So you would have guessed, probably the vast majority of people would have guessed that the stock market would have been lower. And so what action would you have taken? You probably would have bought a bunch of put options, for example. Those are things that when the market falls, you can make a lot of money because it's basically just buying protection for the stock market falling. Or maybe you would hear all those things and you'd say, oh my gosh, I'm just going to sell all my investments, go completely to cash, and figure out what to do later. If you did that, you lost a lot of money because the Dow Jones at the end of 2020 basically ended the year at about 30,000. So the return for the stock market this year, given everything that happened from January to December, was around 21%. That is crazy. Just to show you another example, maybe a less extreme example, in December 31st, 2017, the Dow was at 24,700. And what if someone from the future came and told you that in 2018, you would see real GDP growth of 3%? You would have a fantastic economy after huge tax cuts and big job gains, some of the best job gains and lowest unemployment that the economy had ever seen. And what would your guess of stock market levels have been at the end of that year? And the stock market was down at the end of 2018. It was about 23,000, down from that 24,700 level. So there's a random walk theory that basically says that you do not know the next direction of stock market movement. You might think you do, and there might be something that's more likely than not, like it might be more likely the stock market goes up than down, but you don't know. And I hope that that is something that you can accept humbly, because I certainly accept it, that I cannot predict with any degree of certainty what's going to happen in the market in the future. If somebody could reliably predict that, they would be a multi-billionaire. And so you have to be very, very cautious about these predictions. And even the multi-billionaires that can predict certain things happening in the economy, they often get things wrong too. And a lot of times, the multi-billionaire hedge fund people out there, they'll get rich from making one call that's really, really good. So for example, there was a hedge fund manager that made this huge bet on 2008. He made a ton of money, and then he basically didn't do very well the rest of the next 12 years, even though people invested a lot of money with him. And he made a killing because hedge fund people take usually 20% of all the profits they earn someone on a trade. So being an asset manager is a great business because you can really make a lot of money off of other people's money. Anyhow, there is such a thing as momentum investing. And the best example of that this past year has been Tesla. It's hard, honestly, to talk about investing without at least mentioning Tesla, just because it just dominates the imagination. Momentum is a powerful stock market force. Investors will pile into something with the expectation of a trade being one-directional, with nothing but buy, buy, buy. And that's kind of what's going on right now. Not a lot of people want to get in front of a freight train stock market increase like Tesla. People are afraid to short it. Like John Maynard Keynes, the famous economist, said, markets can stay irrational a lot longer than you can stay solvent. People will still short Tesla. People will still take the other side of that trade, but people have lost so much money and gotten so obliterated from making these trades, it makes people even more afraid to do it, which causes even more upward pressure on Tesla. And a lot of retail traders that don't understand investing, they see Tesla at over $800 a share, and they say, wow, it must be going to $1,000 a share because it's just done nothing but go up. And so they underestimate risk and they overestimate the potential for return. So for example, a company that's hundreds of billions of dollars, that company has a lot less room to grow than a company that is $1 billion. But people look back at past performance and they think of that as the predictor of future results. And that's not how investing works. You don't get to buy lots of stocks at yesterday's prices. You don't get to go back to 1970 and buy your medical school or dental school degree at 1970 prices, even though you can show how much money you would have made and how little you would have had to pay back in student loans if you could have borrowed at that level. I'm just going to be honest, I think Tesla's probably in a bubble right now, and a lot of these other stocks that have just soared in 2020 are probably in bubble territory too. Maybe these companies eventually grow into valuations. For example, Amazon, they grew into fundamentals. Investors were predicting the future of Amazon, and they ended up being right. And Amazon grew and grew and grew as it actually fulfilled expectations and even beat expectations. But sometimes when investors get super enthusiastic about the future, such as something like America Online, they're not correct. So we don't know what the future is going to hold with all of these big companies. But I will let you know that our investing strategy made a lot of money on Tesla growing. And the reason is we suggest the Total Stock Market Index Fund for your U.S. allocation. So that fund had Tesla as a big allocation very early, and it captured the full growth of a company like Tesla. And we have a new company that's something totally different that changes their industry. That fund will also capture the growth of that company. So what will 2021 bring? In early 2021, one big trend that I'm seeing, one big trade after the Georgia runoff elections giving Democrats control of the Senate, is the cyclical trade out of growth and into value stocks, which who knows if that'll continue. But why would a Georgia Senate runoff cause Facebook stock to go down and Chevron stock to go up? So Democrats control the Senate. Wall Street's expecting big stimulus bills that are way bigger than they have been before. And to finance that, Democrats are likely not going to raise taxes in the middle class and upper class to pay for this. They're going to probably increase the deficit and sell bonds to finance these spending decisions. So if you sell a bunch of treasury bonds, and that's going to increase the supply. And if you have a lot more bonds, investors have to get a better interest rate to be interested in buying those bonds. So growth stocks are heavily dependent on low interest rates. Growth stocks are companies that you can think of the names, Peloton, Netflix, all these stocks that you're expecting are going to have their best days way ahead of them instead of now. And you use something called present value to calculate the value of a stock like this. So I'm just going to give you an example. Let's say that you have a company that's going to have a $10 billion profit in 30 years. That would be worth $5.5 billion in today's money for that $10 billion payment in 30 years if you use a 2% interest rate to calculate the value. When interest rates are so low, future profits are worth way, way more in today's dollars because investors, if they have low interest rates, they don't have as much they're giving up waiting around for big money later. But when interest rates are higher, there's way bigger costs to waiting around for profits that might happen someday in the future. In the case of a higher interest rate environment, you would rather have companies that have profits today. So if you used a 5% interest rate, in other words, if you pretended that interest rates went up because of inflation, because of extra stimulus bills, because of an overheating economy, which the Fed wants to control, but they've said that they are not going to try super hard to control it, then you would discount that $10 billion profit and it would only be worth $2.3 billion in today's dollars. So something as simple as what are the interest rates in the economy depend on if a $10 billion payment in 30 years is worth $5 billion or $2 billion in today's money. So if the only cash flow that company was going to have was that one cash flow, if you had interest rates go up by 3%, that would justify that company's stock falling 60%. That's one of the big risks out there for 2021. That's an extreme example. There's other things that go into a stock's price, like supply of outstanding shares, investor perceptions, etc. But it tells you why value stocks outperformed on a day where Democrats took control of the Senate, which isn't really an obvious thing unless you kind of break it down. So investing can be super complicated. If you ask someone who's made a lot of money trading for what their reasoning is for their strategy, it's likely going to be a surface level response, which means that the money they made was based on luck and not skill. For example, it would be irrational for me to go to Vegas and expect a non-expert blackjack player giving me tips would help me win. For example, if somebody like, your aunt or uncle that barely knows how to play blackjack went to Vegas and wanted a lot of money and they told you how they did it, would you expect that would help you make a lot of money? No, that would be ridiculous. You would know that it's a casino, they just got lucky. But in investing, we do this all the time. So people right now are saying things like, well, stocks are not trading on fundamentals. The fundamentals are so, last year or last decade or last century. Investing's totally different now. And I disagree. I would say that stocks are trading on fundamentals in the economy. If you expect that Amazon's going to earn $100 billion in profits a year in 10 years, for example, then today's valuations are pretty reasonable given super low interest rates. However, like I mentioned, if interest rates go up, a lot of our most popular, biggest companies could crash really hard without actually having worse economic prospects. I traded $10 billion of municipal bonds when I was a bond trader. That's a lot of paper that I traded. I would routinely buy and sell pieces of securities as big as $10 million, negotiating over the price of those securities for portfolios that were $100 billion. We had teams of portfolio managers and traders stalking the market for opportunities. And when we found opportunities, they would last for maybe like a few minutes. In the stock market, those opportunities only last for like a split second because high-speed trading firms take them away immediately before individuals can even take an action manually. One thing that I would say about 2021 investing is we're in a FOMO environment. People are kicking themselves for not buying Bitcoin when it was at 4,000 earlier this year, or Tesla when it was at 80 a share. For example, my own kid brother bought a Bitcoin mining stock because he's seeing a bunch of people on Reddit talking about it, and he's made a 400% return on that money in only 2 months. He's totally thrilled. Now, obviously, he thinks he's very smart from doing that. And yes, good, more power to him, but you have to think about investing also in terms of risk. What is the variance of your investment return? If something can go up 400% in 2 months, there's a really good chance that the thing that you're buying is a complete speculative bubble. Because if something can go up that much in that short of a time, that also means that it could fall 98% over the same period. That's not investing. That's sort of flipping a coin and hoping it works out. That would be like saying, well, I need to hit $2 million to be able to retire, and so I'm going to take $1 million to the casinos, and I'm going to put it on black. And if I hit, I can retire. If I can't, I have no chance of retiring. Now, obviously, that's a little bit too harsh. My brother's young and enjoying playing around in the markets and taking a little bit of a gamble, I guess. And I guess it's better than, investing in FanDuel or something, like making bets on sports games, which is probably an even worse chance of making money. I mean, I guess it's better than some things he could do, but something that goes up so fast is not as much as an investment it is pure speculation. But the thing about speculation is often our neighbors will speculate or our family members will speculate, and it makes us want to do it because we're social creatures. 2020 has been so hard on so many people in part because we like hugging, we like seeing people, we like talking, hanging out with friends, going on trips, right? We like other people. We like what other people think about us. We care about what other people think about us. We care about what other people are doing and how their lives are going, and we compare. That's one reason why, if you look at one of the original 10 Commandments, what does one of them say? Do not covet, because it was such a problem that they had to talk about it thousands of years ago, just as much of a problem as it is today when everybody looks at Instagram and wishes they had someone else's life. And so people kick themselves because they consider people dumber than them, they see people dumber than them making way more money. The only thing worse than missing out on Tesla is to find out your brother-in-law made 20 grand in a week buying options on it that he didn't understand. He thinks he does, but he doesn't, but the money in his account is real, so it causes envy and makes us think, well, shoot, I'm smarter, so maybe I should open an account and take action too and start trading options because, everyone else is talking about it, so I should do it as well. Whenever you hear about an investment strategy, it's probably too late in terms of individual stocks or individual option strategies, because once that strategy has, experienced very high success, the opportunity is a lot less and the risk is a lot more. So for example, in March, we thought we were entering the Great Depression. Tesla was maybe at 80 or something like that. Is there more risk? Was there more risk back then when it was at 80, or is there more risk when it's at 800? A lot of people will say, even though it's totally wrong, that there's less risk when it's at 800 than back in March when we thought we were entering the Great Depression. That's not how investing works. But everybody and their mother starts talking about speculative investments once they've soared because it gets everyone's attention. And we know right now that in 2021, a lot of the big names in the markets have extremely high valuations with way more room to fall than they had back in early 2020. So there's two emotions in the market, greed and fear. Back in March, the emotion that we were battling was fear. Right now, the emotion that we're battling is greed. To win at investing, you have to master both emotions by having an automated, regular investing plan that doesn't depend or react to greed or fear. A lot of people are still fearful right now, but they're fearful of the value of the dollar. They're fearful of inflation with so many massive stimulus bills. There's the sort of the crypto folks out there who see all these cryptos as salvation from this problem because it's decentralized, not subject to central banks. And so how have you had a cryptocurrency like Bitcoin more than double in 1 month? That doesn't make sense. There's no fundamental return to this. Gold has been around for thousands of years. Gold has roughly gone up at the value of inflation long term because people accept it as a store of value. If everyone in the world just decides to accept Bitcoin as a store of value, then yes, it will go up in value, and some of these folks will be right. But the thing is if people change their mind, and generally speaking, I've seen cryptocurrency be a lot more correlated with extreme risk trades, risk on, risk off type trades, then we could actually see it go down to almost nothing. So that's not an investment plan to take a gamble on what you think the future will look like. Now, sure, you can do it, but it's just not a high probability gamble. You might think it is, but it's not, because anything, remember, from a variance perspective, what does a normal distribution look like, right? You have upside and downside. And so if something can soar so much, so fast, that by definition means that it could fall that fast too. If you think about what that means for your portfolio, do you want to just take a gamble on your financial future, or do you want to take steps that are going to ensure that you're going to be wealthy and ensure that you're going to have financial security one day? Now, I don't know if you saw the movie 21. It's a little awkward now because I think it was a Kevin Spacey movie, and obviously he had some bad things come out about him. But the premise of that movie, it's a pretty good movie, I think, actually. MIT students go to Vegas and use statistics to make thousands of bets at blackjack, and because they can card count, they are basically guaranteed to make a lot of money, and they do. And one of the big moments of conflict in the movie is when the main character takes a big bet based on emotion instead of math, and he gets into huge trouble for it. again, it really is about controlling your emotions when you're investing and having a very specific strategy, knowing what mutual funds to use, knowing how to pick those mutual funds, how to set up automatic contributions, which accounts to use, how to save money on taxes, how to enact certain trades that are going to save you that money in taxes. So I'll tell you another personal story. I had a Bloomberg terminal when I was a bond trader that showed me the latest economic news and trading info, and it cost like 20 grand a year. It was like buying a brand new car every single year. That was the expense. Every professional investor has a Bloomberg terminal because of needing to access high levels of information. So these are the people competing with regular folks on Robinhood, just trading for free constantly. Who do you think wins that trade? Long term, it's going to be the professional investors. However, short term, sure, the people on Reddit talking up all these different stocks can make a lot of money. So that's the other thing is you want to have something that's going to work long term, not something that's just going to work short term. I remember I took back when we were still allowed to do international travel to Canada, we went to Toronto because my wife's from Canada, and we were taking a ride sharing trip. The driver had his phone up on the dashboard, and he also had a split screen with like directions and his stock portfolio on there. And I thought, well, that's odd. So I decided to ask him about it, and I said, well, what's your what do you do there? It looks like you're really interested in the stock market. And he goes, oh yeah, like I make tons of trades every day, and I made $50,000 this year. And I thought, wow, what's your strategy? And he explained this really complex strategy. And I said, well, how have you done over time? And he said, well, it's been a little bit of a tough road lately because, I made a couple bad calls on XYZ, whatever. And I actually started with maybe about 100,000 more than I had invested. And so here's this guy that has a net loss of $50,000. Presumably, if he's a ride-sharing guy, he's not extremely wealthy, right? So he's lost $50,000 day trading, and he's addicted. He's got the ticker symbols up on his phone, making short-term decisions, and he's cost himself 50 grand in a year when the overall stock market went up double-digit percentage. So that's the danger of trading. It doesn't always work out that way short-term, but long-term, that's how it usually works out. So our investment course, Six-Figure Debt to Six-Figure Net Worth, is open for the next couple days. We have completely updated it for 2021, and this is something also that you will have a limited 2-day $100 off discount if you go to studentloanplanner.com/investing. So what will you learn in something like this? We go into detail what mutual funds to use, where to set up accounts, how to set them up, what diversification we would suggest, how much you should have in stocks and bonds. We talk about what 2021 could bring and smart tax strategies to save money no matter what, so that if stocks go up, you'll make money. If stocks go down, you'll be prepared with a trading strategy that's actually not like, it's not an individual stock bond trading strategy. This is a very straightforward trade you can make to save tons of money in taxes if stocks go down next year or this year. And then if markets go up, then you'll make money and you'll be happy too. Now, the tax trade that we're talking about is tax loss harvesting. Pretend that stocks go down 30% in 2021 and pretend that you own some of the total international and total US stock index funds. If you'd invested 100,000 and let's say you would have lost 30,000, what you can do is sell those funds and buy very similar but not identical funds. We tell you exactly which funds that would qualify in our course. And you wait 30 days and you put the money back into what you had. Now, you're still invested, so you didn't actually lose money in reality. But what you did is you took that 30K paper loss and you realized it. Now, what does that do for you? The IRS allows you to save $3,000 a year in write-offs against your active income for capital losses. So even though you didn't really lose money because you didn't actually sell permanently, you can take that $30,000 loss and you can write off $3,000 against your income for 2021. Now, a lot of you with IDR plans and state and local income taxes and federal income taxes are in, a 30-40% bracket. So that's like $1,000 of tax savings every single year. And if you don't use all of those losses for that year, then you get to carry those losses forward and apply them to future years. Essentially, what you would do is over 10 years' time, one trade saves you $10,000 in income taxes and without actually losing money long term. So those are the kind of things that you're going to learn, actionable, specific things that will cover the cost of the course in multiples. So that just specific example that I gave, $10,000 in tax savings over 10 years, that's about 30 times higher than the limited time $100 off $299 price for this course. We added a brand new section on 529s and UTMA accounts for kids. A lot of you know I just had a baby daughter, and I want to show you how to financially protect the next generation if you were planning on having children or if you already do. So you might not have known this, but a 529 is basically the Roth IRA of saving for college. You get a ton of tax benefits, and if you think ahead for your child, it's going to make a huge difference in their lives and financial anxiety that you've experienced. Obviously, if you can help it, you would probably prefer your kids to have to go through less of that than you went through. But the primary purpose of this course is to help you invest for your future, regardless of what your family plans are, whether you have kids, if you're single, married, whatever. It works for everyone. You'll have a clear path to 6 figures of assets in only a few years after taking this course. And it's something that if you follow the rules and the guidelines in this thing, you're going to have a 95% or greater probability of hitting that. It's not a 50-50 gamble like investing in one of these soaring stock names we've seen in 2020. Because 2021 will be different. Investing strategies will change based on tax laws, economic environments, new companies that change their industries. So that's why you need a specific plan with a step-by-step guide. A lot of you have gotten student loan plans from us, and we love making those plans. But net worth is assets and debt. It's not just debt. If you don't have a good plan for increasing your assets, that's not going to allow you to retire one day, even if you have a rock-solid, rock-star level student loan plan, which is why we got into doing this in the first place. Again, this course is completely updated and overhauled. You have lifetime access for all the future updates, and you can access this course after buying it whenever you want. And this is the 2021 version. We've updated this thing 4 times, and everyone who's ever bought the course before has access to all the future updates because you get lifetime access. So if you act in the next 2 days, you get a $100 limited time discount that we're providing. It literally expires very quickly because we usually charge $400 for this. And it's $299 if you go to studentloanplanner.com/investing. You can also find this link on our website. If you check out the homepage, you'll see our course listed as one of the items on our menu at studentloanplanner.com. This really is the best product that we have besides our consulting service. And again, it fulfills the growing your assets part of things, whereas our consulting service and refinancing services cover the figuring out your debt side of things. There's a full money back guarantee within 7 days. Only about 1 in 40 people ask us for a refund, and generally when they do ask for one, it's people that are investing experts already, thought they might learn something new after being experts. And this is not something that's necessarily designed to be an expert level course. This is designed to be an sort of beginner to intermediate to slightly advanced level course. So there's a extremely high chance that you're going to love this thing. And it's a lot cheaper than spending thousands of dollars per year on a financial planner, and it's going to show you how to invest your money yourself, and no one will ever care about investing your own money well better than yourself. And even if you do hire somebody at some point, which is a totally defendable position, it still helps you become an informed consumer, which is going to be a lot more likely that you're going to hit your financial goals if you understand what's going on with your investments and you understand how good investment plans should look like. So 6-figure debt to 6-figure net worth, $100 off discount only for January 2021. That's literally only going to be around for a day or two after this podcast drops. So studentloanplanner.com/investing. You can also find it on the website on the menu. It'll say course. You can click that. And if you have any questions about it, reach out. Thank you so much for listening to today's show. 2021 should be the year that you dominate your finances, no matter what happens. And I hope it's going to be a lot better than 2020, but we don't know. And regardless of what that person from the future comes back and tells you about all the scary things that might happen in the future, if you get an investing plan and you understand what you're doing, you have a step-by-step path through growing your wealth to 6 figures or 7 figures, then that's going to change your life. And this is the only thing that I'm aware of that focuses on investing specifically for people who owe significant student loans, who have a lot of considerations with refinancing, when to pay off debt versus invest, when to go for forgiveness, and how to fit that into an investment plan. So studentloanplanner.com/investing. Thanks so much for listening to today's show.